you put money in a 401k. So you put $1 in, they put $1 in. On day one, you get 100% rate of return on your money with that. And if anyone knows anything about sequence of returns risk, like there is no better time to get the 100% rate of return period than at the beginning. Mm-hmm. And so the fact that it goes in, they give you free money.
Information presented on this program is believed to be factual and up-to-date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey guys, welcome back to another episode of the Charme Wealth Management Podcast. Today, I am joined by one of our other advisors, Carissa Bertrand. She's an accredited wealth management advisor. And today we are talking a time-relevant topic today, which is retirement accounts. What kinds and what's a tax treatment a little bit, so that as you kind of get through your taxes this year, you can be thinking about what kind of accounts should I be, saving and investing my money in, and what are some of the implications of that? How does it work? Can I get my money out before retirement? When do I pay the taxes on it? Did I pay taxes on it? What happens? We talk about all that. So do your best, stick with us through the end. I know a lot of financial stuff can just be the worst to talk about, but you're here to get answers and we try to deliver. So with that, enjoy the episode. It's an important time of year to just revisit different account types because it's, for a lot of people, it's like their last opportunity. It's the last ditch tax play they can do. And sometimes it's just like, it's a good opportunity to get things started too, if you have never gotten started before. It's been not uncommon for me to meet with people in quarter one of the year, and they're trying to get started in investing. They had a good year the year prior. They put together a bunch of cash, and all of a sudden they could put together some projections and make sure that they were going to qualify for income the prior year and the current year, but they could do right away their IRA contributions I love this particularly in Roth IRAs, but just for like last year and this year all at one time. If they're married, they can go, like their spouse and them at the same time. And so all of a sudden somebody goes from like, hey, we didn't have anything set up for retirement to like, we had a really good year. And now, within the first couple of weeks of putting things together, they have, $28,000 in retirement, right? Like it goes from nothing to something really, really quick, and can this time of year for people that have obviously the availability to do it. And that's just, sometimes it's more encouraging for people and gets them really involved and interested in staying the course and continuing to do that than opening something up and putting $50 every Friday into it, right? Like,
yeah, for sure. You get to see a lot more movement when there's actually a starting balance in the account. So it helps keep people motivated.
Yeah. But like retirement accounts can be tough because there's a limit to what you can put into them. So there is a lot of questions that we get around retirement accounts. And we're going to break that down today into sort of, you would kind of have to put it into quadrants, but there's two main categories of types of accounts. And then there's two categories or primary categories of tax treatment of those accounts. So like kind of four subcategories, if you will, right? Okay. So let's talk about the first group, and that is what I would call or refer to as ERISA accounts. And ERISA, if you want to look it up, ERISA with an E, is it's just a set of laws designed around workplace retirement plans.
So these are going to be the type of plans that you typically see through your employer. I don't know if you're wanting me to get into that yet.
Yeah. Let's call them out. Like people are familiar with these ones. 401k,
403bs, 457s, those kinds of things that you're going to see through your employer.
Yep. Like those are the big ones. And we're going to stay pretty much with the big accounts today that people are or really hopefully should be familiar with. And if you're not, hopefully you get familiar here. So ERISA accounts are important to understand because there is some different nuances to them. They're provided by your employer and they're governed by ERISA. So they have some different rules around them and, liability for your employer, what has to be available to you, maybe some costs, or even cost restrictions, right? Like there's just different things. So, The common structure that people are going to run to is most common is a 401k at work. And people will ask us, is it a good idea to invest in our 401k? And the first thing we want to remember is like the 401k isn't the investment. The 401k is a plan, and thus you get an account in the plan, and you still have to choose and select the investments within it, how you invest the money, right? Mm-hmm. Now, one of the important rules with ERISA is that these plans have to have default investments. Okay. So if you open a 401k and you know nothing about investing, right? And you aren't paying somebody to help you, and you don't want to read a book about it, and you don't want to ask your, weird options day trader uncle about it at Thanksgiving dinner, whatever, there's a default. And that default is typically nowadays a target date fund, which is simply like, you're going to see like target date, 2060. What that means is it lines up with you reaching typically 65 or 67 in that year, 2060. And so that's what they would default you to, is that fund. And it automatically allocates you to a portfolio of a mix of stocks and bonds, typically, that naturally, the older you get, the closer you get to retirement, they use the words de-risk the portfolio, right? Or change the risk allocation. I'm not going to touch that today in this episode with understanding risk in portfolios, but their theory is they're going to sell your stocks as you get older, and they're going to buy you more bonds automatically, right? You don't have to do anything. It's a default. Not my favorite option, but if you really don't know and you're really just trying to get started,
it's not a bad option.
Well, here's the thing. If you're young and you're getting started, your biggest impact is going to be your savings rate, not the rate of return, right? So if you look at it and you say, well, I can save $10,000 and get, the default is, so I got, an 8 or 10% rate of return in a really great year. Okay. So you made like $800,000 in your retirement account or something. And if the alternative is like, or I want to like really pick some crazy investments, and I think I can do something that does 100% rate of return, and I saved $1,000. You're like, okay, well, you have $2,000 now.
Yeah.
You still have way less than the guy that was just like, yeah, I figured out how to spend less money and save more money into the 401k. And so early on, your savings rate is going to make the world of difference than the investment selection itself. Yeah. So if you have a 401k at work, you're not contributing, I tend to encourage people to do that. It's a decent place to start.
Yeah.
Let's talk about the first, we're going to revisit, but remind me when people say, but that locks it up and I won't be able to touch it till I'm in my 60s.
Yeah.
Right?
I have a story about that.
Well, okay. So remind me, we're going to revisit it.
Okay.
So ERISA plans, those are the stuff where it's really nice. You go down to HR, set them up, and they take some money out of each paycheck typically, and do a lot of it for you. It's really typically a quite easy thing to work with, and a great place to get started for a lot of people.
Yep.
Okay. Then you have, outside of ERISA, you have individual retirement accounts, or IRAs.
Yep.
And these are accounts that are in your own name, and they don't have the same rules as ERISA. Now, they do have limits still to how much you can put in them. And if you're eligible to put money into them, there's some income limits that may prevent you from putting money into these. But generally speaking, you got to go open this up yourself. So whether you're on a platform like Robinhood now offers the ability to do IRAs, or Charles Schwab, like that's who we custody all of our assets with, is Charles Schwab. There's generally not a cost to open these accounts. Yeah. If you transfer them between a custodian, sometimes there can be a cost to do that. It's typically really minor though. But you have to remember, if you open this account and you're really gung ho, you're like, oh man, I got extra money. I got a couple extra $1,000. I'm going to open an IRA this year and really start saving for my future, whatever. So I get on charlesschwab.com and I open up an IRA, and I figured out how to link my bank account, and boom, I put the money in there. And then you just go back to, your life. You're missing a very important big step, which is, it's not an ERISA plan where there is a mandated default investment alternative, right? You just put cash in an IRA and it sits there as if it was in like a savings account, right?
So it's really doing nothing for you unless you actually get it invested.
You get the tax treatment, but as far as it growing as an investment, you haven't done anything. So you have to make sure that you then go take a little bit of responsibility for yourself build a little portfolio or figure out what you want to buy or invest in. And in an IRA, you have sort of the world at your fingertips, right? Like you're in an IRA and you love gold. You can go buy gold ETFs. You can buy funds that hold silver. You can buy stuff that like more mimics a hedge fund and what they're doing. You can buy it, low cost index funds. You can buy international stuff. You can buy US domestic stuff. You can buy small cap stocks. You can buy individual stocks, right? Like if you think a certain company is going to really go up and like in your IRA, you can go do that. There's not a limitation by regulation the same way that ERISA plans have. And so, kind of the world's your oyster, so to speak, right? You have a pretty big array of things. Now, still a couple of, limitations. You can't access leverage in the traditional way. Like you can't use margin the same way on IRA accounts. Just be aware that if you start trading complex instruments like options or futures, there could be issues there. You want to like really know what you're doing if you start getting into that kind of stuff. But you have those tools at your disposal. Like you don't have the guardrails, right? The same way as you do in the 401k.
You take off the bumpers. Like
totally.
You don't have bumpers in your IRA that like you do in your ERISA plan.
Yeah, and you can gutter ball.
Yep.
You definitely really can hit the gutter balls, and you can hit 10 of them in a row. So yeah, just be like, 401. That's a really good way to think about it. 401k workplace plans, kind of like investing with the bumpers on a little bit, but don't let that discourage you from getting an IRA, because most people, if you look at maxing the 401k, is still not going to get them to where they want to go in retirement.
Yeah.
You have to do something different and additional. Most people.
Yep.
Okay. So those are the two big sort of categories of accounts, right? Stuff you do on your own, stuff you do at work. The next layer down to consider is tax treatment. And that's where in tax season, we really start to focus. And, so they have the big one is traditional, and that's what people think of. I put money into the 401k. Typically, unless you make a different election, that's what they call traditional. Go. So, if you put $10,000 in the 401k this year, you get a deduction on your taxes for $10,000 of income, right? So if you had made originally $100,000, you put $10,000 in the 401k, you're actually only paying your income taxes based upon an income of like $90,000 this year.
Yep. So you're like throwing that tax liability down the road. Yep. And so it's considered a tax deferred account. There's always so many different, names that are used when it comes to these types of accounts and how they're taxed, that it can be confusing for people when you're just getting into it. 'Cause you're like, well, what's a tax deferred account? What's a taxable? All these different kinds of words that are coming out that mean the same thing. But, that's the traditional account.
Tax deferred. You haven't paid the taxes. So as your 401k grows, you will eventually have to pay taxes on pulling those funds out. Now, there is a nearly unlimited amount of content on the internet that talks about how devastating that is and how bad it is and how the government is your business partner in your 401k and all of this stuff that, you don't actually have $1 million in your 401k. You have 500,000 because you're going to have to pay half of it in taxes. And here's my caution on that is I have yet to see somebody with a high degree of intelligence saying that's not trying to just sell you something else, right? They're trying to discourage you from what I would call a generally good decision to buy whatever they're selling, right? Now, do I think people should have all of their money in traditional 401ks and IRAs? No. Most people that can cause some issues, and particularly it's just the rigid nature of retirement planning at that point. You have less flexibility. So that leads into the second type of an account, right? From a tax treatment, which is Roth, which is like, I love Roths. That Roth, music to my ears. And the reason why is because you can invest the funds. And although you pay taxes in the present, and no one likes paying taxes, I get it, right? Like no one wakes up in the morning and goes, you know what I want to do? Save. I want to pay my taxes and then save for retirement. Like, it's like,
I'm going to just send the IRS some money just because I feel like it.
All else being equal, I'd rather pay taxes on $10,000. Well, we're in this current tax environment of low taxes. I know what I'm working with. And then invest relatively aggressive and not pay taxes on the money I take out later. And so if all else being equal, like say, as an example with an undefined amount of time or whatever, 10,000 grows to 100,000. I pull out 100,000 at any time, all in one lump after I'm 59 and a half, assuming I've met the 5-year rule and other small nuances. I don't owe any taxes on it. I don't owe any taxes on 90,000 of the gain. And when I'm in retirement, it doesn't mess with my Social Security and how much my Social Security is taxed. It doesn't kick off IRMA surcharges, which is where you start paying more for your Medicare. And if you just need access to big chunks of capital, like you just can do it, right? Yeah. It's just easier. So you end up with traditional and Roth. Traditional, tax deferred, you still owe taxes on it. Mm-hmm. Roth, you've paid the taxes on it. Gotten it out of the way. Yep. Now it grows. And in the future, hopefully you make it to 59 and a half and you can get all the money out tax-free. Mm-hmm.
One of the questions that comes up when I talk to people about Roth IRA versus like a traditional IRA where it's tax deferred is people are like, oh, well then why would I ever do a traditional?
Yeah.
Like why would I ever put money in that? I'll just do everything in Roth.
Let's talk about that.
So I want to talk about that for a minute because when it comes down to a planning standpoint, and you kind of have like led into this a little bit, it's good to have diversification, right? Mm-hmm. So it's nice to have some of that money that is tax deferred down the line. And the reason for that is because you get a tax deduction and you're paying less taxes at the time you put that money in. And then on the Roth side, obviously you've already paid those taxes as well. So then you're not paying it then. Yeah. But it's nice to have that diversification there because then you're not just pushing all your taxes down to the end of the line or vice versa with the Roth. You're not just paying all the taxes up front too.
Yeah. Well, I think someone that actually does like a really good job at explaining this in a relatively understandable manner for a lot of people is David McKnight in his book, The Power of Zero. Now, for a certain demographic of people, David's planning is quite effective and a strategy if taxes are your primary concern. However, when he gets into the usage of indexed universal life insurance as part of the retirement plan, I may have some disagreement with him about maybe who should be considering that and how much and whatever. There's some nuanced differences. So I just, as a disclaimer, Dave McKnight, good guy, like his book.
He's been on the podcast.
I don't agree with everything. He's been on the podcast. He actually is from Wisconsin. Anyways, great guy. In his book, though, he really calls out in like a really nice way where he says like, you don't want no traditional dollars because there's still this thing called the standard deduction. So, like last year was a standard deduction last year, 25,000 for this year for married like couples.
Nearly 30,000 this year.
Okay. I don't have my tax table in front of me. Forgive me, everyone. I generally have it with me at all times. I just haven't memorized the 25 tax brackets yet. So let's say it's $25,000 flat. And so let's say you have $25,000 in income. You take a standard deduction. All right, like you didn't have to have any expenses. You didn't have to keep receipts for this. You just get to take the deduction, and your income goes to zero. So if you have all of your money in Roth and life insurance and whatever, and all of a sudden you just go like, okay, well, hey, I didn't make any income this year because, I had Roth distributions or borrowed against my life insurance. Well, like, hello, you could have had $25,000 of income and then still paid no tax on it. Yeah. So you want some traditional dollars so that way you can fill up that bucket still on the low end of the income spectrum that you take the standard deduction against. Now, some people are just very fortunate to be in a situation that they're so far beyond that they're going to have RMDs, and it's just part of the planning process. Like you can only feel so bad for somebody that had great market returns over, the years and whatever, sometimes you just have to pay taxes. No one likes it. I get it. I hate taxes as much as the next guy, but sometimes you just have to pay. You want some traditional dollars though, to fill up those lower tax brackets. And then as you get into a tax bracket that you say, gee, I don't, for example, right now, there's a big gap in the tax code. And the tax bracket is between 12% and then it goes at 22%, a 10% jump. So at first you have 0 or 10% and then 12%. And then you have the 22% bracket. So you might say, well, I'll take my traditional dollars all the way to 12% because when I deferred them, I was in the 28% bracket or I was in the 34% bracket. So man, if I'm taking them out at 12, that's awesome. And then once I hit the limit on the 12% bracket, I'm just going to start taking Roth dollars or I'm going to start borrowing against other assets for income, right? And then you can start playing this game of push-pull later in retirement. So generally, what I encourage people to do when they're thinking through, okay, well, now I'm in tax season. Now my account's saying you can do some contributions to retirement accounts. What should I be doing? How am I thinking about this? Generally, if you're younger and you think your income's going to increase over the years, I tend to say, do Roth contributions.
Yep.
Do Roth contributions as aggressively as you can. For most people, that's going to make sense for two big reasons. First is if your income's growing, I want to defer income later on when tax rates could be higher and your income's going to be higher. So like the bracket itself could be higher and you would be pushed into a higher bracket. You would have then paid less taxes on the Roth dollars and allowed it more time to grow. And then maybe later stage in your career is where you start doing traditional. Now, the reason why you want to be cautious, the second reason why you want to be cautious about doing it early on and saying, well, I'll do traditional is later on, as you are earning more income, there is a phase out on Roth contributions and you can't do them. However, if you have your finances set up correctly, you can execute something called a backdoor Roth. I'm not going to get into it on this podcast because it would take a little bit of time to explain, but there's an important thing to remember. And it's that if you have traditional IRA dollars, we're just going to let you know, it creates a real big tax headache and it more or less limits your ability to do backdoor Roths. And your accountant will probably hate you because they'll have to file an 8606 every single year, start tracking cost basis, and the whole thing just pretty much sucks for everyone involved. So you want to be really careful about doing Roth conversions when you make too much money to qualify for an IRA contribution and a Roth contribution, but you're trying to execute Roth conversions or backdoor Roths, particularly backdoor Roths. Roth conversions in and of themselves won't cause an issue. Yeah. It's the putting the money into the traditional IRA with basis that causes an issue. If anyone curious to know,
I would definitely recommend speaking to a tax advisor or a financial advisor if that's something you're considering, because if you do it wrong, it's going to really mess things up. And it gets a little bit complicated. So
it's really big financial pain when you realize I thought I was doing something to save taxes down the road. And what I did was doubled my income on that allocation in the current year. Didn't get the tax advantage later on that I was hoping to. And I had to pay my accountant more to handle the entire situation.
Well, here's an example.
It's rough.
I've been going through helping with some taxes. And there's an individual who said that they did a Roth conversion. And I'm going through all of the tax documents and looking at the paperwork there. And what she did was a withdrawal from her 401k. And it's listed as a normal distribution, except that she is not 59 and a half yet. Okay. So that triggers an early withdrawal penalty that she has to pay to the IRS. And then in addition to that, she withheld state and federal taxes from that amount. And then she took what was left over and went and put it as a contribution into a Roth account.
Okay. There's a lot of nuances there.
There is.
That this could turn out okay. Maybe a lot to unpack, but I think the call out is
work with a professional.
Be careful when you're moving your tax allocations like this, right? You want to make sure you do this the right way. It's so easy for people to see the TikTok videos now or the reels that say, do this, and they just go execute. And there's some nuances that look, I hate that our financial system's set up the way that you clicked the button wrong. So now you have this huge consequence and, and it's like, I'm not I am this is what I do for a living, but most people are like, I'm not a sophisticated person, I'm not as sophisticated in the financial system. And, it's like, I just clicked the button wrong and sent the check the wrong place by accident. And now I ruined my whole retirement. That's not I hate that. I hate that that's the system we're in, but it is the system we're in. And I can't change it. The best I can do is try to do a really good job helping people navigate that, which is what we do.
And that's the whole point of it, is the call out of just make sure that you understand what you're doing or work with the right professionals for that.
Yeah. Yep. So, okay, to visit really quick before we wrap up, because sometimes people don't want to put money in their 401ks or IRAs because this is the common concern. Oh, that's going to lock up the funds until I'm till I'm retired, right? Those funds are going to be locked up. And that is just patently not true. Here's a couple things. If you pull money out of a traditional account before you're 59 and a half, like you go to your 401k and you're just like, oh, liquidate me out, send me the check. You pay income tax, all the income tax you've deferred, you'll owe it. And then there is a 10% penalty if you're younger than 59 and a half. First note that I help people understand is, okay, if normally because you're working, you're in like the 22 or 24% tax bracket, so you're deferring it off, and now you get laid off, and that's why you need to access your retirement funds. Okay, you're paying a 10% penalty, sure, but the odds of you being in like the 10% bracket is all of a sudden relatively high, like 10 or 12% bracket. And so now with the 10% penalty on top, get this, you're back at 22%, which is exactly where it was that you would have paid otherwise, right? Which is why they have the 10% penalty. I believe. I mean, look, if somebody has some hardline data of why the heck a lawmaker does what they do, reach out, hit me in the comments. But so like that's one thing. It's like, it's not so catastrophic. Yes, you have to pay a tax penalty, but you're likely in a lower tax bracket when you need to access those funds. Yep. Second thing, most 401ks, if they're through a workplace, like an individual 401k for a self-employed person would be different, but like a workplace 401k generally has a provision that you can borrow money against it up to like $50,000 as long as you have a large enough account balance, right? Yeah. So if you need to borrow against your 401k to pay a medical bill or, help a kid with college tuition or whatever, right? Yeah. Fix a car, get a down payment for a home.
Yeah, there's a few different provisions on things that you can look at.
Generally something that you would want to explore and say, does my 401k plan have this type of provision? Most of them do, I would say. And then the other opportunity you have is, well, there's two other opportunities. The first one would be a Roth conversion ladder. So when you do a Roth conversion, you start a new 5-year period on the dollars you converted. That it does have to be in the Roth for 5 years before you can take it out without getting the same tax penalties as if you had just taken it out of the traditional IRA initially. But for somebody that's going to like retire early, like maybe you hit it big in your IRA or something and you're like, man, I'm going to retire at 40, but I'm going to need these funds out, to live and retire early. You could do like a Roth conversion ladder and strategically plan your income that way. Your other option is what they call 72T election, which is where you more or less annuitize the account. Now, there's a bunch of nuances with a 72T, and you are going to want to include 2 people at a minimum in this decision, your financial planner and your accountant. And like, that is the bare minimum. You want to make sure you get this right. You can have really disastrous consequences and side effects with a 72T election that can, and I kid you not, really derail what you think is going to happen. Yeah. So there's just some nuances where you want to structure the whole thing correctly, but it allows you to, as long as you take out a series of substantially equal payments over a certain number of years and time frame that you kind of predefine, it allows you to not pay the early withdrawal penalty, right? So that's an option. So there is options. Now on a Roth, this is cool.
This is one of the other reasons we love it.
This is what I love about Roth. If you put money in a Roth, guess what you can do with it? Because you've already paid taxes. You can pull it out. Is that easy?
Yep.
So in a Roth, cost basis always comes out first. And so if over a couple of years you put, $30,000, $40,000 in a Roth IRA, you get in a pinch and you're like, man, I really need $15,000, $20,000. Look, don't go to your Roth as like the checking account or the savings account, because once you take it out, you can't put it back in, and you want that money to grow and be tax-free in retirement. But if you're in a real jam, you pull it out, there's no tax penalty, right? Like
it just gives you a little bit more flexibility than a traditional account would.
Yeah. Yeah. Right. Like, I know I've talked to people where they're like, what do I do to get started? And I'm like, put your money in a Roth IRA. And they're like, but what if I need it? And I'm like, it's sitting in a savings account, right? But like making goose egg, nothing.
Yeah.
And they're like, yeah. And I'm like, well, so just put it in something that makes a little bit in a Roth, like, I don't know, money markets paying a reasonable rate. You know what I mean? Like, and if you need it, because next year your life's unpredictable and you need it, just the $6,000 or $7,000 you put in, you just pull it back out, and maybe you're left with a couple $100 of interest you'd earned along the way, and that stays in there and it keeps growing tax free, eventually. Yeah. Which is better than, having to just sit in this savings account and do nothing. Like, look, that's something more geared towards like really young people. But I find that sometimes that's like with, people later stage too, that just didn't maybe plan ahead or think things through enough or.
Well, and even going back to the conversation at the beginning of the 401ks, when some people are like, well, I don't want to, invest in a 401k because, whatever, it's going to lock up my money. I actually met with a woman a couple of years ago, and she was of that sentiment, but she was now in her 60s, never utilized a 401k. And one of the main problems that I saw with that and discussed with her is that, yes, she had been able to create a good savings and retirement plan for herself through some other means, but her employer that she had for the last 20 years was giving a 6% match on any funds that she put and contributed into her 401k.
Hundreds of thousands of dollars on the table.
She missed out on so much money. And even if she had only done up to the match, if she had just contributed up to the match in her 401k and continued the rest of her investment plan, she would still have so much more money.
Okay.
And her retirement would have been just so different. And that's just what kills me there.
Two things about the match to understand. First is a vesting schedule, right? So even if your employer is like, we do 100% match, all the funds you put in the 401k, which they can't, that's not a real thing. But they're like, we have a 5-year vesting period. So whatever we put in on your behalf, if you don't work here for 5 years, you don't get any of it.
Right.
And you're like, well, I'm only going to work here for 2 years. Like I got other plans. Look, like take that into consideration. It still might not be a bad play just in case you wind up staying more than 5 years because something changes.
Well, and it's not like you're missing out on your contributions either.
Yeah, you got to keep
those over.
You got to keep your money. And by the way, it's not invested in the company typically, unless it's a publicly traded company and they offer that. But it's like, you're not like giving your money to the employer to like invest on your behalf.
Yeah.
Right. Like again, default options, there's a menu of options. You can go in and select it, how you want to invest it, all this stuff. The second thing about a match is, look, you could have, and pardon my crass nature here, some really dog crap investment options in the 401k and say, I'm a way better investor somewhere else. I can invest in real estate and get this great return. I can invest in, gold, or I can invest in whatever. I think like maybe the one caveat is if like you're a magic man with crypto, maybe, but realistically, you put money in a 401k. So you put $1 in, they put $1 in. On day one, you get 100% rate of return on your money with that. And if anyone knows anything about sequence of returns risk, like there is no better time to get the 100% rate of return period than at the beginning. And so the fact that it goes in, they give you free money from there, it could have really mediocre performance on the investment results. You are so far ahead. It's like not even funny. Like it's like, dude, take the free money. If your employer is trying to give you free money,
part of your compensation package.
If they're planning on it, get this. If your employer is offering a match, you're getting paid less. Like you're likely getting paid less because they offer the match already.
Yep.
Like because they've calculated it into the total compensation they're offering people. And so like
you're all else being equal, money.
You're kind of letting yourself be hosed over if you're not taking a match. Look, and some 401k plans are not as funly, the design is not as fun. Okay. Yeah. Like sometimes the match is great. Sometimes the match is like, you're like, man, who designed that plan? Right.
But still, it's
like, even if it's where you put in, even if you put in 1% and they do a 25% match on your contribution. So you put in $1, they put in 25 cents. Like there's still not a better time to have a 25% return than on day one. Right. Like that's still, it's not as great as a really sweet match, like $1 for $1 match. but like, dude, it's free money still.
Yep.
It's free money. So like take into consideration the vesting period, just be aware of it, right? Like I've had people leave jobs and they're like, I've got $50,000. And then we like look at the statement and we're like, you're not vested and you already left the job. So you don't have 50,000, you have 20,000, right? Yeah. Or you have 25,000, whatever. So just be aware of that. But like, don't let all the stuff about there with life insurance and annuities and gold and real estate and all that dissuade you from taking prudent steps to make reasonable decisions that have a good proven track record of introducing a high degree of opportunity to be successful in a retirement plan, which is, in my belief, a 401k. A workplace retirement plan has a lot of value. It helps solve a lot of the behavioral issues that we face as investors. IRAs are a really great place if you can save additional funds. Like, really try to get that going for yourself. And if you're filling up all those tax advantage buckets and you need to do something more for retirement planning, that's when you can start getting maybe a little bit more fancy and, figuring some things out. We certainly do a lot of work helping people figure out what is that thing going to be. Yep. And sometimes it is real estate and sometimes it is for people like crypto, or maybe it is, buying certain stocks or taking that kind of risk. And maybe it is, a life insurance, cash value life insurance plan. Like there's all these different opportunities and there's all these implications with all of them. If you get to that point, I encourage you to get some professional help, whether it's us or someone else. Get some professional help that, people that know what they're doing and can guide you through the nuances that come with all of those opportunities and options. But, look, we talk about this today because during the tax deadline, you still have the opportunity to fund IRAs, typically, as long as you qualify. That window will close around April 15th. I don't know. I haven't looked at the calendar. What's the deadline this year? Is it 15th or is it 17th? If the 15th falls on like a Saturday, you have till Monday, which is why sometimes it's the 17th. So you have basically till you file your taxes to do an IRA contribution for last year if you haven't. So if you're at a point, late stage career, you want to do, you qualify, you want to do an IRA contribution on your tax bill, you can do that. If you're self-employed, you want to do a SEP IRA or something to that effect, you can still do that, right? If you want to make sure that you're setting yourself up for retirement, and you're younger, whatever, and you want to consider a Roth contribution, you can do that still. But you got to do it for like last year, which means you're filling up the bucket from last year. You still have the opportunity to make more money and fill up the bucket for this year. On top of that, once we get past that period, you cannot go back on retirement accounts and say, well, I didn't do a contribution the last 3 or 4 years. I want to put a whole bunch of money in. It doesn't work that way. So, take this opportunity serious, talk to your accountant about it, ask them if you're qualified. If you work with us, ask us, our opinion. What do we think? We're certainly happy to look at everyone's individual situation and help guide them through that decision-making process. Caveat I'll toss on. If you ask your wealth management advisor or you ask your financial planner, should I do traditional or Roth? And they come back with, we don't do tax planning. Our lines are open. Please give us a call. That's all I'll say.
Yep.
Please, dear God, seek a second opinion.
It's just, tax planning is just so important when it comes to your overall finances and your financial plan. So
essential for so many people.
Yeah.
It's the easiest place. Look, it's the easiest place to pick up a bunch of efficiency. And if you are worth $100 million, you can afford to be inefficient, right? Like, hey, park $200,000 in your checking account. What does it matter, right? Like, but most people, right? Like, even if you're high net worth, even if you're, even if you have a sizable retirement, like you still typically can't really afford to be inefficient. And the smaller it gets, the less you can afford that inefficiency. So, and remember that like the size of your net worth is always like relative to your goals, right? So for some people, $5 million isn't a lot of money. And for some people that would be all the money, but like tax planning is just like, it's like freebies almost sometimes, right?
Yeah.
And so you want to pick up the efficiency you can there, right?
Absolutely.
Don't let the tax tail wag the dog is what I always say, but guys, let's get real and make good good tax decisions in conjunction with our investment decisions, in conjunction with our insurance decisions, in conjunction with our estate planning decisions, and all the rest. So now that we've sufficiently confused you guys,
go back and recap. So we've got the different types of retirement accounts, the ones that are through your employer.
They have default investment options.
What did you say? Worthless?
What?
Did you say the ones that are worthless?
No. I said, no, the ones through your workplace. And they have,
none of them
they're
are
not worthless. No, they have the ones through your workplace, ERISA plans, and they have default options. So they have, like really easy to do.
Automatically invest for you.
Yeah.
Right. But then the ones that you do on your own.
Make sure you got to invest. You got to invest the funds.
Individual retirement accounts.
Yeah.
Just having the Roth or a traditional IRA, that doesn't cut it. You've got to choose what
you actually
you're invested in inside of those accounts.
And the world is likely your oyster.
Yes.
So do some good research or get some good help. And then you have traditional Roth. And I think we talked about that. If you're early stage and you're young, probably worth considering Roth, but get some individualized advice still on all of this. And if it's, if you're late stage career, you have it available, you can make the contribution, whatever, you may consider traditional.
Yep.
That those are kind of like the two generally accepted ideas, right? Like everyone's individual. So it all goes back to your own situation. So if you're like a little confused and you're uncertain, just get some help. Pay your accountant to do some tax planning or pay a financial planner to do some planning. And, I know we don't, us at our firm, we don't always just have to manage people's assets like we do. If people want to just pay us to put together some financial plans and projections or give them some guidance, we do some hourly engagements, we do some flat fee, project-based stuff. It's available. It's not cheap, but it can make a world of difference still. So, what else? Yeah, just do it. Just do something, right?
Yeah.
I don't know.
Something's better than nothing always.
In a world of confusion, I don't know, reach out to a good professional.
Yeah, I think time is your best friend when it comes to investing. So
that is an understatement.
You can start, the better. Whatever type of account that is, just get started.
Time is your friend until it's your enemy. And anyways, it's a good conversation for a portfolio episode. Yeah, we'll save that. Okay. Thanks for checking in with us, guys. If there's anything you want to hear us discuss, you have questions about a certain planning topic, whatever it may be, send us a message, call us, email us, leave a comment on YouTube, whatever. Let us know somehow that you've got a question, you've got a topic you want to hear us talk about, or you've got a certain type of professional you want us to bring on and interview or talk with, whatever. Let us know. We'd love to make a targeted episode to try and work towards getting you the answers you're looking for. So find us at ducharmewealth.com and pretty much all your major social media platforms except TikTok. Not on TikTok anymore. Bye, TikTok. See you guys later. We're out.